Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you for joining us this week. So happy to have you. Where we're going to cover three of the points we had in this week's investment allocation meeting. We're going to talk about Japan, a topic that has come up a few times here recently that we've discussed. We're going to talk about high yield bonds and associated investment risks. Sometimes it can become easy to focus on one side of the equation, return, but we, of course, focus as much and usually more on the risk side. And then we'll take an updated look at another spin on the presidential cycle. So let's jump right into the currency impact on Japan ETF. So what we've covered recently has been a really strong Japanese stock market. It is a surge to highs that hadn't been seen since the late 1980s, and it's generated some of the strongest returns internationally over the past year or say 3 years. It's benefited our portfolios. It's benefited Warren Buffett, who made sizable investment back in 2020. But today we want to focus in on the dynamic of what it actually means to invest in Japanese stocks if you're a U.S. investor. So you have a couple of different choices. For most, what you will do is you will buy a fund. In our case, we'll just talk about an exchange-traded fund. The most popular is EWJ. It's an iShare that tracks the popular Japanese stock index. That's the purple line on this chart. You can see there's not a lot of return to that ETF, even though Japanese stocks have been strong over the past year. And the reason is because when you're an American investor and you're just buying foreign stocks, you're also doing so denominated in yen. And so the other dynamic is that their currency has really fallen hard over the past 3 years because we have higher interest rates here. We're at 5%. They've just come off of a negative. And so investors have wanted to sell yen, buy dollars. And so that is to actually depress and actually cancel out the returns you would have had from just owning stocks. Now, our preference in our portfolios is to purchase a version that actually hedges the currency version and keep it denominated in dollars. And that has actually done the reverse and added to the return. That is the orange. So this is one of the dynamics we have to pay attention to. Looking at internationally, we have made some adjustments in a few different places where we want to minimize this risk because now it's to the point the yen has fallen where the Bank of Japan doesn't want it to fall too low and could very well step in and have successful intervention and prop that back up. So we don't want to speculate on that. But again, risk is the primary thing we want to focus on and really take some profits where we can on something that has been successful. But primarily, I just want to keep our eye on the ball that you take many risks when you invest internationally, not just the associated with the stocks, but the currency as well. So now we'll turn our attention to high yield bonds. I think a question came into us and it really provided some good observations in how to analyze investments. So if you would just take your regular high yield bond fund right now, it can look pretty appealing because what you'll find is something that looks like an 8% yield. All right, pretty nice little fat return. However, that kind of hides the risks because when you buy high yield bonds, you also take high risk bonds, which means that a good number of them in any given year will likely bankrupt. And so we have to factor in that there's going to be some principal loss as well as income stream from those bond funds. And even a modest default risk, we put a little pencil to paper and find that it's very easy to have 2% principal loss shave off of that return. And so 6 looks very different, especially when you can have that in some very safe bonds as competitors. So the other thing we have to keep our eye on is that high yield bonds tend to be not long in maturity. Banks, investors don't want to lend these companies money for 10 or 15 years when they're of high risk. So usually it's a 5-year period, and we're going to be entering a window where those bonds that were issued in a low interest rate environment face higher yields. So we're looking at a pretty complex chart here. There's an orange and there's a blue. The orange is showing you how much higher interest rates are now relative to where they were 5 years ago. If it goes all the way back into the 60s and you see it peaks, the highest levels on these charts were in the 80s when we shot interest rates up into 15, 16, 17%. So obviously bonds at that point in time were refinancing at very expensive levels. Several of you will notice or remember maybe a painful experience having to do that with your house. The same was with high yield bonds. But right now, except for those 1980s, we're at a very high point where these are going to have to be reinvested or refinanced at high levels. And that's a concern that we also want to pay attention if there's a reduction in the number of companies who can actually do that. It'll be a painful experience for those bond holders. So again, we have to balance not only potential return, but the risks we're taking as well. So those are a couple of my points. I want to pass it over to Andrew now to take an updated look at the presidential cycle.
This was a topic that we discussed quite a bit in the third and fourth quarter of last year, looking at how stocks trade depending on what part of the presidential cycle that we're in. And so this chart here breaks up the 4 years and looks at how different parts of the market show strength or weakness depending on, again, where we are in the presidential cycle. We looked at this last year when we came into about August, September, and traditionally when we're in the third presidential year, that we start seeing stocks have a little rough period, but then we see a year-end rally. And that's exactly what we saw the market do, where we had that 10% pullback in the third and fourth quarter. We bought it in October, and then we had a nice rally into year-end. So now we fast forward to today, and we want to see what is the presidential cycle telling us right now. And so what this chart's looking at specifically, it's kind of a risk appetite type ratio. So that orange line on your screen is looking at broad cyclical stocks divided by defensive sectors or different defensive stocks. So think of that technology, consumer discretionary, and then more defensive stocks being utilities, healthcare, things like that. And so what we saw is a really strong start to the year where tech stocks driven, like we've talked a lot about on the market cover, by a lot of those Mag 7 type names, Amazon, Microsoft, Tesla, NVIDIA, things like that, had a really strong start. And now we're starting to see them pull back. And that's following pretty closely to what traditionally we see in an election year for 2024, where you can see in that blue line traditionally begins to go lower as the market starts to favor more defensive names. Now, this doesn't necessarily mean the market itself goes down. This just means we start seeing a shift in preference by investors out of those broad cyclical names and into more defensive parts of the market. And that could be that rotation can be very healthy. One of the adages in finance is rotation is the lifeblood of a bull market, where we start seeing investors shift from one sector, one core of the market to another, and that's what can propel the markets higher, that type of rotation. And so that doesn't necessarily always happen, but it's definitely a possibility. So what we're seeing right now is, again, starting to see that rotation to where tech stocks have started to cool off. We started seeing utilities and healthcare start to improve, and that's very much following traditionally what we'd see in an election year. Looking now forward out to the end of this year, again, we can start seeing that blue line bottom. Traditionally, we do see that bounce, the shift back to cyclical type stocks towards the end of the year. And then the next year, the first year of the presidential cycle, 2025, has again started to favor those more broad cyclical type names. And so this isn't something that we want to be the primary directive for how we approach the market, but we view it as a secondary tool, something that we don't want to necessarily ignore, but kind of keep in the back of our minds of where seasonally things move during different parts of the year. And right now we're doing a pretty good job of this current market tracking what typically happens in an election year. So very, very interesting stuff, and it's something we'll continue to monitor and discuss and see if there's implications for our portfolios going forward.
Awesome. Thank you, Andrew. And thank you to all of you for giving us this time. We sure do appreciate it. As always, give you a reminder that if we can be of service, please give us a call, 800-928-4001, or scan the QR code and book it electronically. Thanks again and have a great weekend.